ITI MF Outlook November 2023. Global economy. Key happenings of the past month. All global as well as domestic indices ended the past month in negative owing to the risk of Israel-Palestine war and looming threat of high US Treasury yields as well as crude oil prices. US Fed left interest rates unchanged, yet it will continue to reduce its balance sheet by selling Treasury securities. It indicates that the interest rates might remain higher for longer. First half of 2023 was good for global equities while Q3 saw some correction. India's key indicators. Recovering GDP. GDP has been recovering consistently since the COVID-19-led decline. Satisfactory GST collection. GST collections remain strong, a print above Rupee 1.50 lakh crores seems to be the new norm. High forex reserves. A higher forex reserve is better for the overall economic stability and in turn stability of the equity markets. India market cap to GDP ratio. After a sharp decline in financial year 20, India's market cap to GDP ratio remains strongly above the historic average. Buoyant capex outlook. Capex, which tends to have a major multiply effect on economy, is growing steadily, which bodes well for India's growth engine. Power. Historically, power demand in the economy has grown at a pace lower than the GDP growth. However, over the last couple of years, the power demand in the economy has grown at a multiplier of the GDP growth. Demographic dividend. The pace of growth in high-income and upper-middle income group is faster, indicating a shift in spending pattern in the coming years. India's consumption drivers. The pace of urbanization, nuclearization, internet penetration is pointing towards a strong consumption story. The power of compounding over long term. Market analysis indicates that probability of negative returns is very low over long term. The 7-year rolling returns of Nifty 50 index is 11.1%, Nifty Mid Cap 150 index is 15.5% and Nifty Small Cap 250 index is 12%. Valuation of 12M Forward P/A ratios. 12M Forward P/A ratio of Nifty is below its historical average, Nifty Mid Cap above its historical average, Nifty Small Cap slightly above its historical average. Equity commentary. While domestic macros and corporate performance has been on the mend, the record-breaking run since April 2023 has FII to thank mostly. Valuations in some stocks are now peaking and we could see some moderation in FII buying. Rising crude oil prices as estimated can fuel inflation, which is already on the rise. Also, if there are earnings surprises from market bellwether stocks, buying support could cool down. While the current rally shows little signs of slowing down, retail investors must continue investing in well-managed funds via SIP. Our fund strategy. With macro situation being very dynamic and volatility increasing across asset classes, we continue with our strategy of running well-diversified portfolios. The volatility is likely to continue over the next few months as the market outlook is likely to remain challenging. In the short term, the equity markets will be dependent on the news flow of the geopolitical tension which has recently emerged. Investors wanting to invest in lump sum can invest in dynamic asset allocation funds. Investment in equity funds, particularly mid and small cap categories, should be done systematically over the next 3 to 4 months in the form of daily, weekly STP or SIP. Past performance may or may not be sustained in future and is not a guarantee of any future returns. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.